All right, so good morning, everybody. This is a weird presentation for me because I get to talk to you and everybody's muted, but we are going to use the question and answer box in the Zoom call. So if you've got anything you'd like me to address specifically, feel free to send me a note there. We're also going to be doing a follow-up questionnaire for everybody to just give us some comments on how we can make this a little better and more useful for everyone. So my name is John Talarita. I'm on the senior team here at Heffernan on our board. I've been around a long time. I serve as CEO of our operation in London, and I also run all of our carrier relationships, amongst other things, here at Heffernan. So the marketplace in its current state is definitely a hot topic internally within Heffernan, and obviously externally as well. I spent a lot of time talking to underwriters, heads of carriers, other peers in the brokerage community, just getting a feel on what's going on out there. And my goal today is just to share with you some high-level observations on what's going on in the market, get a little bit granular, in particular to California, and then hopefully we'll have some time for any Q&A. And again, feel free to put that on the Q&A box in the Zoom call. What I want to run through today is I'm going to do 4 individual topics, run through just kind of how we got to where we are. So observations on the current marketplace and kind of what's driving a lot of the changes in the market currently. Speak specifically about California and what's happening in the state of California. For those of you outside of California, what happens in California actually does impact you, as well as states like Florida, Texas, et cetera. So those states, because there is such a concentration of risk, they do tend to ripple across the country and impact other states. So it's still relevant, although not specifically relevant to your exact state. The impacts that carriers are feeling and what we're seeing ground level dealing with our insurance carrier partners, and then some best practices that I would recommend personally to clients as they navigate an incredibly difficult marketplace. So historically, the insurance market, honestly, a lot of the norms that we're used to historically in the insurance market have been thrown upside down. Things like I was an underwriter decades ago, and used to always count on making money on certain lines of business, auto being one of them. And those are just no longer making money. We're in a weird state of affairs in California right now where the most profitable line of insurance for carriers is workers' compensation. 20 years ago, that would have been unthinkable, and you would have laughed out of the room to say something like that. But it's just a very weird, and a lot of this is the change in the climate. Regardless of why it's happening, the issue is the climate is changing. It's changing across the country, and the weather patterns are impacting loss. So this is an example of 2022. And as I run through these numbers, keep in mind that when the World Trade Centers, when that loss occurred, it was devastating for a number of reasons, obviously. But the insurance industry there was concern that it would bankrupt the insurance industry. That claim ended up totaling about $61 billion or $62 billion. When you see the numbers I'm talking about today, that's kind of in the rearview mirror. But that was a claim that they were worried would bankrupt the business. So insurance is for the most part, a private industry, and there is a finite amount of resource available to insure risk. And these changes in the climate, as you can see by this slide, hurricanes, wildfires, floods, the increased activity. And I do want to make the point, I'm going to be speaking primarily about North America today. This is an issue that is throughout the country. So carriers that are, most insurance companies have global operations or have some related global operations. So these challenges are facing in North America are not, it's not just happening in our country. This is happening globally in terms of changes in patterns. In the US, we have 100-year floodplains that have flooded 5 times in the last 20 years. So those kind of phenomena are really throw upside down the actuarial analysis these carriers do to model their exposure. If you look at Hurricane Ian is a great example. That was a $65 billion loss, but that was in the middle of a year with a lot of other losses. And that put, that's to about $115 billion. The market's kind of positioned in general, it plans out about 80 billion, and that is changing. And there's a lot of fear that it's going to continue to change. And this interesting thing about winter storms, this comment on this slide, that was, you could usually count on the time of year when you'd have losses. Hurricanes are a specific time of year. That's been changing. California wildfires was a specific, third quarter. That's really, or late third, early fourth. That's really changed. This year in California, thankfully, we have a very good winter. Everything's green here. It's amazing. But last year, our wildfire season started in March. So one thing that is driving a lot of this is the reinsurance marketplace. So for those, some of you are going to be familiar. I don't mean to be too ground level, but insurance companies will write your account, take risk. They will choose to keep some or all of that risk. If they don't want to keep all the risk, they go to the reinsurance market. The reinsurance market, think of arbitrage. It's a tertiary marketplace that's there to reduce risk and take some of the risk away from the insurance company. And it's a gamble. They're taking a bet. They're using their capital to make bets on the individual carriers. That insurance comes in two forms. Comes in treaty reinsurance, which is an annual, sometimes longer, but typically an annual contract, which tells the carrier for these specific types of risk, I'll let you offload these over to the treaty, and you keep $300,000 on $1 million claim, and I'll take 700 or $1 million exposure. I'll take 700 of that exposure. That's simple. Facultative is where the carrier goes out on a one-off situation and has to solve a problem. They're trying to write an account, doesn't fit in their particular treaty. What's happening is that in the industry, up until just recently, there was about 700 million of $650 million billion of reinsurance capacity in the marketplace. That now, the capacity is still there, but it's not being put out into the market as actively. And a large chunk of it was some VC and PE players decided to get into the business and thought they could go at it and create a whole new marketplace, capitalist approach to reinsurance. And that didn't work. It blew up. But what happened was, it was such a, this slide here, you see, it was $95 billion of this capacity. That $95 billion is now gone, not to be replaced. And the weather is not changing, and the changes in the exposure are not changing. So what happens is, if the carrier can't hedge, then that changes their ability to take on a risk. And what we're seeing right now is insurance companies, some cases, want to insure something, cannot get the reinsurance to do it. So a good example is and this is really impacting a lot of, you're going to feel this mainly on catastrophic loss. Catastrophic loss being not, including but not limited to floods, hurricanes, wildfire, and in California, particularly earthquake, which I'm going to speak to in a little bit. So things like states like Florida, they're having a huge challenge right now in Florida, whereby you just cannot get insurance. Its carriers are not offering insurance in the state anywhere near the level they were before these losses, before Ian and others. So that puts them in a position that it's interesting in their particular case. The state of Florida is looking at their legislation and starting to wonder if maybe they could be doing things a little differently and make it a little more friendly for insurance companies. Historically, it has not been a very insurance company friendly state. So interesting with Florida, the statistic I just learned the other day, which was really interesting, is 9% of all personal lines claims in North America are in Florida. Yet 80% of the litigation around personal lines claims is in Florida. So those are the kind of things that, and we have our own issues in California, and other states have their issues. So insurance is regulated by the state. So the Department of Insurance in Florida is working with the state legislature right now to severely limit this litigation issue, so that they can get capital to come back into their state and insure, because it has, between the losses and then this adverse market on litigation, they've flood the state, which is obviously a problem. So that's, let's see, I just want to look at my notes here on, all right, got everything I want to do there. So it's a brutal marketplace. I mean, this is probably the worst one I've seen. I came into the business over 40 years ago into what everyone thought was a worst hard market until about a year and a half ago. One major difference is, back then there was an issue. There was just a lack of capacity. and it wasn't coming in, and it was just took some time for the capacity to come back in. People just have been blown out of losses in prior in the early 80s, mid 80s. The difference here is there are people sitting on the sidelines refusing to put out their capacity. So the capacity is there, but there's an underwriting discipline that is now permeating the business, which isn't necessarily a bad thing for the investors, but it's really brutal for those of us on the ground level that have risks to insure. So specifically to California. So that's the overview on the market in general. If anyone has any questions, again, please feel free to. I'm looking at two screens because questions are over here on my right. If you pop those in. So specific to California, reinsurance in California initially was very concerned with wildfire. I'm now seeing that really impact earthquake. So, and I think flood's coming because there are parts of the central part of the state and other areas of the state where flood is becoming a real problem. So, and again, that's just with the changing weather patterns in the state. I mean, if these atmospheric rivers keep flowing into California the way they have been and dropping this amount of rain, our whole profile from a risk standpoint is going to just do a 180. So the reinsurance markets are absolutely pulling back on California. Capacity is absolutely impacted in California. We're seeing on catastrophic claims, so windstorm, flooding, earthquake, a lot of those didn't have in our state percentage retentions, and most of them had hard deductible numbers such as $25,000 deductible, $50,000 deductible. We're seeing almost across the board a press to go to a percentage of value on these or a percentage of claim. Depends on the carrier, depends on the wording, but 2, 3, 4, 5% of the values or of the loss rather than a fixed dollar retention on the catastrophic side. So you are going to be seeing that. If you haven't seen it already, you're absolutely going to see it on earthquake. Earthquake typically is about 2% in California. We're seeing everything getting kicked up generally at about 3 or more. So that is going to be a continued problem. We're seeing limits restricted, and that's entirely reinsurance. The capacity to reinsure has just become so restricted. That's where a lot of the impact is. Also in California, you're going to see on non-admitted right now, a lot of the business we place is on an admitted basis, meaning it's registered with the Department of Insurance. They pay tax, they're regulated by the Department of Insurance. Every carrier has the ability to write non-admitted. The admitted structure has a specific rate plan that allows for only a certain amount of deviation. So and only a certain amount of deductible variation. So for example, you're filed in the state of California for a property and liability package program. Let's say you're a Travelers or a Hartford or a CNA, you can write up to maybe $100,000 deductible, and it's all set what you can do in terms of discounts offered for that. That is problematic because there's some people now looking at clients are getting 40% increases on premium and saying, I want a higher deductible. Those admitted filings don't allow for a $500,000 deductible or $1 million retention in some cases. So that's where the non-admitted marketplace, it's not overseen by the DOI. They do one-off policies and they can write in the state. That's offering more, it offers more flexibility to write the accounts, but and you're going to see that usage of non-admitted increase in the state of California as carriers and capacity trying to find more creative ways to help clients. The other one, the DOI inactivity, one of the frustrations that a lot of the carriers are telling us about California is that the California Department of Insurance, there are a lot of outdated policy forms and outdated technology in the state via the carriers because they haven't been able to get their most current policies filed with the Department of Insurance in California. There are 100 reasons why that's happening, but the bottom line is it does put them in a difficult position. So they're unable to file their best product in the state. So we deal with situations where Chubb Insurance, Travelers, whomever have really great product in Oregon, but we can't offer that product in California. I'm hoping that's going to change over time. The carriers are pressing hard, but that is a challenge for California. So it limits the tools in our toolbox as brokers to help the clients. So in terms of carrier impact, what we're seeing with carriers is a real reduction in authority. So I'm sure you all have stories of you used to get your quotes, right away or a couple of weeks before your renewal, and now you find it's becoming a lot closer to the renewal, or you're not getting the turnaround from your insurance carrier that you'd like to see via your broker. because of this reduced authority, the carriers are pulling back their underwriting authority from the field. So we have to go much higher up in the food chain to get some of our favors done, to even get the responses we need. So that just clogs the line and causes problems in the distribution chain for us. So what would have taken me 2 days a couple of years ago now could take me 2 weeks. And it's frustrating. You know, Heffernan is one of the few independent brokers in the US, has really unique access to carriers. We up and down the structure within these companies, we know from the C-suite all the way down to the local level, and we've got long-term relationships here. And I find me and my colleagues are leveraging those a lot more than we used to, but that access is there rather than some of our larger competitors where, you know, you're the broker in that firm. It's going to take them a long time to figure out how to connect with the head of underwriting at Chubb. With our firm, people know they can get a hold of me or others and quickly get that connection. There's a lot of blanket underwriting, guilt by association, I call it, where you do something that someone else does and they don't do it very well and cause a lot of claims. Suddenly you're a bad risk. And for us, it's really difficult to get people that, you know, notice it. Okay, yes, it might be a tough class of business, but this is a best in class client. Here's what they're doing. Getting the underwriters to even take the time to learn that right now and listen to us is challenging because it's much easier for them to just not write the account. So being a squeaky wheel is one of our newer jobs these days, to really get these guys to pay attention. And then the reduced cat capacity, we're seeing that across the board. You know, an account that had 60 has an exposure in New Orleans. We have an account that has 60 million of cat exposure in New Orleans. We're being told now that's going to be 10. Well, we need 60. So 10 doesn't cut it. So that in the market, it's going to take some time to find that. Same thing with, for example, cyber. Those of you with cyber exposures, we have some clients with some very large towers, 50, 100, $150 million of cyber. Those aren't easy to build as they were 2 or 3 years ago. And it takes, again, it goes back to that time issue. It takes a lot more time to get those things done. In terms of some client best practices, one for sure, if you've got any outstanding compliance recommendations on your account from your current insurance company, I would highly recommend you get with your broker and run through those before your renewal's coming up. We're finding a lot of carriers are, I'd say hiding, that's probably not fair, but it feels like it's sometimes behind recommendations to find reasons to reduce limits or get off accounts. So taking that out of the conversation and removing it from the chain of events helps a lot. And you can be proactive in that by chatting with your broker. Are there any outstanding recommendations? Go through. And if there are things you don't want to do, that's fine, but then have an explanation or a good story as to why that doesn't make sense for your particular risk. But at least we're not going in with no answer to the recommendations of the carriers. And the carriers don't always make realistic recommendations. They never think about how much it's going to cost you as a client. So that's something that has to be factored in, obviously, but that's not what they're going to do. So that's where that story is essential. Meeting in person with carrier reps, especially in this post-COVID world where there's not as much face-to-face, I would highly recommend if you're a larger account with a decent amount of premium going out the door, you get with your broker and talk about the ability to even do a Zoom call with your underwriter and explain why you're such a great account and give them better clarity. So you're not just a piece of paper and you're not just an account from Heffernan, that there's more of a connectivity between the underwriter and you. The relationships matter these days. I mean, we're doing a lot of face-to-face with our carriers, clients as well, but the carriers, it's essential because we need to be top of the pile, and it's harder to get that done. The compelling story element. I mean, all of you have businesses that you're proud of, that you spend a lot of time running and building. Those are stories that do help. They help us. They help the underwriter understand the situation. I'm not going to tell you it's going to always make a difference, but it's not going to hurt. And that extra effort will resonate on some level with the underwriters. And the other one is a favorite for myself, just empathy to the brokers. The brokers in our firm are having a very difficult time. It's no fun going to clients we've known for years and telling them how much a premium's going up and how their limits are coming down, how we got to fix this problem. And it seems like a lot of what we do these days is massive troubleshooting on accounts where things are just going wrong. But I would just encourage you to keep in mind that we obviously have your interest in mind. Our job is to broke for you. We're not agents of the insurance company, but we're constantly putting out fires on our side of the pond right now. It's just brutal. So that is the extent of the presentation. And I hope that was helpful. We're going to be sending out, if anyone has any questions, you can pop into that dialogue. If not, I'll give it a few minutes and I'm happy to, then we're going to be getting you a questionnaire. This is the first one we've done like this. I have a tendency to keep things pretty short, so I'm not big on long presentations, but feel free to give comments how we can make this better, how we can give you some other information. Feel free to reach out to your brokers. They're certainly aware of all these topics. And if you want to reach out to me, certainly can do that as well. But it doesn't look like we're getting any Q&A. So I'm going to wrap us up 20 minutes. I feel like I set a record there. Thanks so much for your time today, everyone, and have a phenomenal day.